The topic which we have for today is variance analysis. And in today's session, we'll discuss variance analysis in complete detail, right from start till the end, practice a very comprehensive example, and do MCQs on variance analysis. Variance analysis is one of the important topics in cost accounting. You get a lot of questions out of it as well. So make sure you understand it very clearly. It's very calculating intensive. You have to calculate a lot of this. But if you understand the basics behind the logic and the formula, you're good to go. If you only try to remember the formulas, there are places where they'll trick you. So just memorizing the formulas won't work. Try to understand the reason behind it as well. And we'll do all of that now. Now, first of all, what is variance analysis? Variance analysis is nothing but a comparison between the budget and the actual figures. The comparison of budget to the actual figures is called variance analysis. Now, at the beginning of the year, let's just say our organization made this following budget. Now, the budget which you make at the beginning of the year for one pre-planned level of quantity, that's your static budget. Now, this is the budget they prepared, where sales is $15 per unit and they sell 100,000 units such that the total sales is 1.5 million. And then they have the cost of sales. Direct material will be $3 per unit, and for 100,000 units, it will be $300,000. Labor would be 4, which will make a total of 400,000. Variable overhead would be 3, and it will be a total of 300. Fixed overhead will not depend upon anything, which will give them a planned operating profit of $300,000. This is the profit they have estimated. This is the pre-planned level of budget they have made at the beginning of the year using 100,000 units. Are we clear how the budget has been made? I think we've discussed preparing the budget in strategic planning as well. If you haven't, you can check out this replay right here. Strategic planning and budgeting, you've prepared these budgets. So are we clear the way the budget is made at the beginning of the year? Now, once the budget has been made, you have actual information. Now, this is where the actual information comes in. This is the actual data for the year. Now, this year, if you see, we sold at the rate of $14 per unit. Instead of the planned level of 15, we sold at the rate of 14. We reduced the price, but we sold 150,000 units such that my total revenue was 2.1 million. My cost of sales was 3.5 per unit for direct materials, 2.5 for direct labor, and 4 for direct variable overhead, which gave me these numbers. And my fixed overhead was 250, such that my operating profit came out to $350,000. That's what happened with my operating profit. It's come up to $350,000. So do you think compared to a budget, compared to a planned level of performance, have we done a good job or a bad job? Have we performed better than what we supposed we would? Instead of $300,000 profit, my profit is $350,000. Did we perform better than our planned level? What do you think? Yes, no? Jack, yes. Catherine, yes. Janet, yes. Anastasia, yes. Okay, what about everybody? Anybody else who thinks our performance hasn't been? If you see our planned budget, our target operating profit was 300, and this was all the data. Now, if you see our target operating profit is 350, our actual operating profit is 350. Have we performed better or worse, or we have to figure out? What do you think the answers are? Better or worse? Brenda says better. Anastasia, better. Figure out. Okay, let's take this example, right? Now, if you look at this, right? So let's just say we have planned a mock test, right? And the planned mock test was out of 100. That was the full marks for 100. And a good score in this, would be 80. That would be good score. Now, when you came for the mock test, I increased the full marks to 500 and you scored 150. Does it mean you scored good? Because again, your target score was 80, your actual score is 150. Does it mean you scored well in this case? What do you think? Everybody's saying no, right? I'm sure you can all see 80 out of 100 was good, but 150 out of 100 was 500 is not good because it's not proportionate, right? It's very less. So that's the case. That's the case here as well. If you see, with the sales quantity of 100,000, if you sold 100,000 units and you made $300,000 profit, that was good. But after selling 50,000 units more, after selling 150,000 units, you made a profit of only 350, then it's not good. We don't know. It doesn't seem good because proportionately your profit hasn't increased as much. Your sales increased by 50,000 units, but your proportionate profits did not. So things went wrong somewhere and we have to evaluate that. And the best way to evaluate that is you prepare a flexible budget. Now, when you prepare the flexible budget, you prepare it for pre-planned level of, you prepare it for the actual quantity of sales, such that the sales level used in preparation of flexible budget is the actual sales. You're using the actual sales data. If you see, 150,000 units have been used to prepare your flexible budget. This is for the planning which has happened. And if you see in this case, the rates which have been used for sales, for direct material, direct labor, and everything else, this is again your budgeted data. This is not the actual data. This is the budgeted data. So your sales price, variable direct materials, direct labor, variable overhead, fixed overhead, that is from the budget. You use both of it to determine the operating profit that should have been there. So if you sold the quantity which you have sold, that is 150,000 units at $15, that is the budgeted price, your sales would have been 2250 instead of 2.1 million. Such that if you see, your total revenue was less compared to the units you have sold. And why was it less? Because you sold it at $1 lesser. Clear? Guys, a yes or no is always important. Make sure you keep on telling me. Now, again, if you see direct material, now our direct material for 150,000 units would have costed me 450, but it costed me 525. The reason it costed me 525 is because if you see the quantity is same, I spent 3.5. I spent $0.5 extra per direct material. Direct labor. Now, labor should have been, again, 150 into 4, 600,000, but it's a lot lesser. So I saved money. Direct labor is where I did a good job. How did I do a good job? I got them at a lesser price. I had to pay $2.5 per finished goods for the direct labor. Variable overhead was supposed to be 450. Here it's 600. I paid extra $1 per finished goods for variable overhead. Fixed overhead